Welcome to Think About It Thursday. I'm going to be sharing a bunch of different activities that are happening in the market right now that are affecting interest rates and are probably affecting what you're dealing with. But there is good news on the horizon. So let's go ahead and just get into it. First of all, what you really need to know is that we are globally connected. And so as globally connected as we are, what happens in other countries is actually affecting us. And recently, what we saw was in the UK, we actually saw that their situation got a little worse and their inflation got a little tougher. And because of that, they actually triggered a little bit of a point with us. Now we're dealing with some of that as well because globally, Moody's downgraded the United States as far as our credit rating. And in doing so, that caused rates to be a little volatile as well. We're also approaching the debt ceiling, and they're going to have to deal with that here very shortly. So these are all parts and pieces of the places that are actually affecting us, including the debt ceiling and the 20-year bond auction that came out, and it was very poorly attended and it wasn't very well done. Now, all that means is that the rates have been extremely volatile the last couple days, and we've seen a lot of ups and downs with the market with what's happening. On the American and on the US front here at home, some of the things that are affecting as well as the labor market. The labor market is actually seeing a little bit of stretch where it's gotten a little bit worse. And in doing so, we usually would see the Fed actually adjust their interest rates accordingly. But the Fed is actually more interested in what's going on with inflation. Now, that's a very interesting point because inflation, as we've seen over the last few months, has actually progressed on the downward slope. So they're ignoring the situation with the employment sector, and they're actually not doing anything on the inflation sector because their real fear with the situation is that inflation is going to be triggered pretty heavily by these tariffs. Now, there's a lot of competing ideas when it comes to this, but in essence, what's happening is that you're going to see that that competing situation right there hasn't necessarily been meaningful yet. At least that's what the White House is saying, because in essence, we've seen the inflation go down, which theoretically that could be true. So there's a little bit of competing value here. I'm going to share my screen here in a second, and while I keep talking, and what we're going to be doing is we're going to be looking very carefully at what's happening in the market. Now, the existing home sales did come out at the same point in time today. They weren't terribly worse than what we expected. They were actually very close to what we expected, and that is actually driving what's happening in the market as well. Now, we're expecting in the next couple of days to see some more housing information come out. Things are not looking negatively right now. One of the good news is for the people who are out there looking to buy is that overpriced offers have actually come down. Now, locally, that's a little different depending on the segment, but last year, 27% of all homes had were over ask price, whereas now we're down to 18. That's a significant drop, which means things are getting a little bit easier and a little less competitive for you. Now, I'm going to show you that right now. I'm going to share the screen to go through the rates here real quick with you so you can kind of see what's happening in the market. And this is kind of a timeline. Each one of these are called candles, and they have little tails sometimes that go down and little tails that sometimes go up. In this case, up is good, down is bad. And so if we come over to here, which is the top of the area right here, April 4th is this date. That was the best that we've seen in a while when it comes to interest rates. These interest rates were hanging around right around 6.75, 6.875, depending on your credit. It could have been better. This is in a conventional 30-year fix. Now we see that the bottom kind of was a downward trend for a while. We saw some recovery back and forth and what's happening. Right here, May 8th, this is where the last Fed meeting was. And in this Fed meeting, they came out and they kept the base as far as flat. In other words, they didn't raise it, they didn't lower it, they just kept it right where it was. While that's not necessarily a problem, what that ended up making is it set us up for a little bit of a downgrade as on the following day or in that day, because we started seeing some of the news that might be coming out in the next couple of days. It might be hotter or worse than we expected. The inflation report was one of them. And then when that came out, it actually was improved. And so that we see a little bit of recovery there. And then we saw a couple more days of what's happened here. And then we started seeing a recovery. And then right here is this weekend, this last weekend. You can see May 16th and then also May 19th. And on this weekend, we actually saw Moody's downgrade the global US credit rating. Fantastic issue, not necessarily a pleasant one, but we saw the rates drop over the weekend. You don't see a candle right here in between, but you see it's the 16th and the 19th. Monday, they opened up significantly lower. They had to crawl their way back up. And then the last couple days right here, we started to see like things were getting better. And then we got the news from the UK inflation, inflation piece, and that actually sent it back into a tailspin because the UK is buying a lot of our bonds. Now, we've seen a little bit of recovery. So here's the good news in the whole situation. The good news is that it's very likely you can see that we've had a prolonged trend line coming down. It looks like we might be set up for a quick recovery in the next few days. Now, keep in mind that from here, from this point right here in early April to where we are here in the end of May, this is really just about a 3/8% in rate differential. Now, that is a big deal, but on a $400,000 home, that's about $80 a month. It's not a huge number, but it is a number to keep in mind as far as what you're seeing with us. Just want to make sure I share this with you so that you kind of know what you're looking at and think about it and think through what makes the most sense for you, because it's still a great time to buy. And like I said, one of the biggest metrics and the best things that I've seen out of this is that the amount of homes that are going for over ask price dropped from 27%, which was last year, down to 18%, which means that there's more availability out on the market now than there was in the past. And this is really a good place for you and a great and fantastic opportunity for you to jump into the market and have less competition if you'd like to. Obviously, rates are a little high, but the projection is that they are coming down. Anyway, thanks so much for joining me, and I look forward to talking to you again soon.